Hi guys, today we'll be talking about the impacts of interest rate, which seems to be the common topic of most people nowadays whenever they are looking at property, whether they are buying, selling, or not even, or just keeping their property, or even looking around only. Is interest rate seems to be a problem for a lot of them. So naturally, people will be talking about it because mostly it's due to the Federal Reserve increasing quite a few times. There's more to come definitely in just because of the cheap money that has been ongoing for many years before that lah. And so in order to curb inflation, this has to be done, which is normal, perfectly understandable, although it is quite scary. But let's take a look at the impacts of it, whether it has an effect of you, whether is it a right time to buy or sell or whichever it is, does it directly affect? Let's take a look. So I took this data from the mortgage wise. We show a few. We got the Fed funds, the US side. Then we got the 3 month SIBOR, and then we also got the 3 month SORA. Obviously this guy is a lot more stable, less volatile, especially since it's regulated by MAS. But this one is more volatile, and then also mostly we have this one that is the most volatile lah, because this one is by the US side. So let's take a look at the impacts of what's to come, what's likely to come when it comes to property prices. So before that, let's take a look at the history. So when it comes to mortgage stress test, right, assuming we've got $1.5 million purchase price, 75% loan, we got 2% and then a 4% comparison side by side. For a 30-year loan tenure for most of us, you will be looking at an increment in mortgage of about 1,000 plus, which is quite scary. That one I admit, 1,000 plus can do quite a lot of things. But when it comes to 1,000 plus, will people be turned off and not buy a house because, or the extra, the increase in mortgage is 1,200 plus dollars. So I think it's very unlikely, right? Because if you're talking about 1 year, 1 month 12 1.2K, so 1 year is maybe about 14K, then 2 years is about 28K. And so far, if you take a look at the chart, so far it hasn't really the high interest rate hasn't really lasted for very, very long. This one try to increase and then drop, then this one try to increase for 2, 3 years and then drop. So if you are taking a look at the increment in mortgage, maybe you are looking at we are not even looking at 4% previously. Okay, so this one was only about 2 plus, and we know the bank rate is usually 1 or below 1, depending on what kind of package that you sign up for. So if you are talking about maybe even let's say 3 years, 14, you got 42K. But for a $1.5 million purchase or rather investment, and next time, even assuming you're gonna sell it off on 1.8, 1.9, and then if you're talking about 40K extra that you're paying, I think this is not really too much of a concern, because when people are talking about investment, we are usually looking at a 6 figure and not really exactly at like the lower or the 5 figure range. So at least from this perspective, it seems like most people are not going to be selling their house, especially those that they buy for own stay, they buy for investment and own stay, which happens to be a large majority of most people, because not many people have the luxury of, I buy this $1.5 million property, I can stay with my parents, no problem. Yes, we do have quite a few of them, but most people will be buying to stay, especially the higher the quantum, the more they will be buying likely to stay. Okay, so let's take a look at maybe 2015 to 2016 kind of range. Previously, it was let's see. Okay, this was the previous slight jump. In mortgage wise, what they call a false start. Okay, and then you see there are two developments over here. One didn't make money even to recent quarters, and then the other one made quite a lot of money, easily six figures, quite very healthy 6 figures. I'm not going to be mentioning the developments today, but we'll just be looking at how different interest rates environments can still have what I call champions lah, champions and losers lah. You got those that make money, what I call the champions, and then you've got losers who don't really make so much money or maybe even lose money. So ultimately, what we are trying to see is that whether interest rate high being too high can still produce champions around in the market or not. So as you can see over here, the champion over here in the green line, it went appreciated about 18.5% gross. For 80.5% gross is quite a lot of money. You are easily talking about 300-400K. Some people probably make easily more than that. Then you've got their blue line, which is supposedly in a much better location, and then didn't manage to make money. Okay, so this was the part where interest rates started to rise, and then people started to get a little bit more concerned, and then after that it started dropping again. So it was not too much of a scare. And then we went a little bit further. That's when interest really started to rise in 2017. So in fact, if you compare to here to where we are currently at, it's almost similar to where we are at. And then people are already buzzing so much about interest rate. Imagine now, now the common topic seems to be interest rate. And then this happened to be like almost like you see almost the same gradient as, or maybe a little bit steeper only compared to 2017. And were there champions around? There was a champion that still managed to make even more, 22.8%. Whereas there's the other guy also launched around the same period, 2017, just slightly later, only appreciated about 3%. And we know that if you appreciate 3%, if you pick the wrong development, you're likely going to be losing money because of your causes of ownership. So this shows that while interest rates were rather rapidly increasing, even in 2017, there were also developments that managed to make money, and this guy obviously made a lot of money, way over six figures. I mean, still within six figures, but way very, very, very healthy range of six figures. Okay, and this was back in 2017. And then we look a little bit further, 2018, where interest rates were really quite scary, because generally the one I'm looking at is actually SORA, because I will believe that the large majority of us were those who bought a home or at least looking to buy a home likely will be looking at the 3-month SORA, because it seems to be at least to me the more logical choice, since it's more regulated by the government, and then much more stable and then you can see the highs are generally not as high as the previous or the other metrics. Okay, so back in 2018, you've got this guy that was launched one quarter after another, and then the one in green, not too much of a loser, at least still make 6.7%, but probably make a little bit more than break even. And then you've got the other guy who is the blue line, is a champion, which is the 18.3% again, which is almost similar to the one back in 2015, 2016. Okay, so that time was the time 2018, remember, soon after the cooling measure, or in between there, the cooling measure that was the end of Q2, start of Q3. So interest rates were way higher than what it was now, what it is now. I remember my interest rates was 2+%. People were a little bit unhappy, but I didn't remember the talk being so fierce, but then again, there's also another champion that made 18%. And then we fast forward a little bit more. We went to 2019. We've been looking at this one as an increase, this one as an increase, this one as an increase. Then we look at the part where it started to drop. Okay, 2019. Then we've got this guy, blue color. Okay, in a very hot location. Recently there's one. Let's not talk about it. Nah, I'm very surprised people even rushing in to buy that development. So, well, let's see how it goes in a few years' time, because there are a lot of people who like to join in a crowd fever where they want to go, where people want to go, they want to go. They don't even know what they're buying So, well, let's see. Only a logicals will survive. Ultimately, it's all about natural selection, right? So, pardon me. Sometimes it's a little bit. I find the market is a little bit too illogical for me. So the one in the blue line dropped actually 12.7%. And then we've got the green line that has actually appreciated even more at 27.6%. And both were launched around 2013 Q3. So which is around this period of time where interest rates, mind you, it was still high, it was still very scary, and there was no absolute certainty that the rates are going to come down all the way to rock bottom. People knew that the rates were going to come down, but they didn't know that most people probably wouldn't know that they were going to go that low. Okay. And then you still got the champion and you still got the losers. So what does it show? It shows that when you've got the interest rate rising, no matter how fast they are rising, there will still be developments that make money. There will still be developments that lose money. So regardless of which, you just have to make sure that when you are shopping around, if you happen to be or you want to time the market, I want to make sure my interest rates environment is low. Why you need to wait for the best opportunity? I need to wait for the next new launch. Then you'll be in for a bad surprise lah. Especially those people who, you know, Hamo and all those Leaf PG and then they waited so long for it and then they realize, hey, I didn't get the good balance number. In fact, I must not myself. One of my friends, his balance number was how much? I think it's about 1,000 plus. And then all along he thought that he's gonna get 2 lakh. So you think about it, 1,000 plus for, let's say example, Amo, 372 units, right? You need to got 1,000 plus ballot. So by the time it comes to your turn, naturally the best selections were all gone. So you have to see whether it's a game of chance, whether is it worth waiting or not. Anyway, let's see. So a lot of people are here, they are saying, oh, the best time to buy was actually back in 2000, 2005, 2006, or maybe 2007, 2008, or after the financial crisis. I even hear people, wow, last time if I buy during the crisis, I'll confirm what, this kind of thing. Yes, you have people who bought, like, made a truckload of money. Then you've got people who made absolutely crazy, mind-blowing numbers. You've got, you see, this guy hold for 97 days, make this kind of money. Not to say it's not good, but it's precisely because of this kind of phenomenon we got the people holding for this kind of just a few months and making this kind of insane money. Was what actually drove the market to insanity levels, and as a result there was a crazy bubble. And nowadays if you want to spot this kind of opportunity, I would say it's actually very hard nowadays. If you're making 1 mil plus in 3-4 years, you are easily top tier. And you are talking about 3 years, 3 years, 365 in a year, and then you got 3 years, you got easily 1,000 plus days. Look at how many 1,000 plus days are there, not too many of them. And then this guy already made 1 mil in maybe about 3-4 months. And nowadays, it is almost impossible to spot this kind of deals anymore because the market has been much more tame. The market has been much more controlled by the cooling measures. So anyway, regardless, we'll take a look at that period of time where people were now people reminisce, as those people, especially those people who have been looking at property for 10 plus years, and then they refuse to make a move because they feel the heydays of properties were over. So they rather let the money sit in the bank, or they go and rather go and play the stock market. I mean, if they are good stock market players, then they're probably gonna get much better ROIs over there. But the thing is, last year, like what I mentioned before, there are a lot of people who were, I could have get bottom. I don't need to buy property now because I have much better ROIs at the stock market. I have much better crypto at the stock market. Who cares about property? Last year, I've been looking at the stock market for over 10 years, and I would easily say that it's not that easy. My discipline level is definitely not there for stock market. So I was just waiting lah. I'll just keep quiet away lor. And then this year you see all these guys that were talking to me about stock market and crypto, suddenly all went silent. Suddenly, some of them started looking at property already. So the thing is, our local market is definitely very, very different from the stock market because stock market there's very little regulation to curb all this insanity up and down. There's super insane up and downs. You got a GameStop going on like this, but our property market is always like this. Why? Because heavy regulation by the government. Let's think about how many cooling measures on the spot. We got, first of all, you got TDS, you got your ABSD, you got your in order to even buy property, you got a buyer stamp duty, which is not really a cooling measure, but it gives you costs. So people will even think twice before they even step in. And then you got a seller stamp duty, and then you got your loan to value ratio. And so all these comes into play, and then all this comes into play and to stop people from speculating, especially the seller stamp duty. Last time, people can buy sell and within a few days. Some of them never even exercise their option. But nowadays, very difficult for this kind of thing to be happening. Back in 2005, we got housing loans of up to 90%. Why I'm going to show this? Because we are looking at this. Usually we know bank spread rate is maybe about 1%, 1%ish, or slightly over 1%. So if we use 3.5, last time I think more people take SORA lah. From what I know is most people take SORA, SIBOR, for my bad, the blue line. Most people take SIBOR last time, and then they add around 1%. You've got maybe a 4.5%. So 4.5%, I would say absolutely is terrifying. Now I'm looking at my the rates I'm paying is only about 1.4 now. At least from what I received, I'm expecting higher, but it's okay. I really set aside the funds needed for that, and I'm anticipating that. So I'm not too concerned about the interest rate myself, because I'm already invested, as I mentioned before. So let's take a look, 4.5%, and then you got 90%. And if you look at the $2 million loan, $2 million property, 4.5%, you got a 30-year, and then you got 90%. Monthly repayment would have been $9,000. Okay, and let's not forget, at that point of time there was no ABSD, blah blah blah, SSD. So it was a highly speculative property market, and that's why you have super and insane gains like what I showed you just now. And hence, with insane gains, you come insane losses. Later I will show you on that. And imagine at that point, 9,000 plus a month, you're paying only 2,000 plus principal, only 6,000 plus, and already way more than the principal in form of interest, 6,000 plus just to pay the bank for every month for your loan. So that was, can you imagine how scary it was? 4.5%. So for those people who are thinking, last time the best time to buy was 2000s, would you dare to buy? I think that's the problem. If it's me, I would think I would. Now I look back, it's easy to say, oh, people look at that time, the PPI went up very high, so fast, I should have made money then. But if you take a look at the loan, it's really scary. Now that I look at this, I'm thinking maybe at that point I would have made a move, because it was so scary. Almost 60-70% of my money installment actually goes alone just to interest rates. But now in the current market, we are looking at maybe, let's say, 2.5% interest upcoming. I'm still paying only, like I said, maybe about 1.4, currently. Definitely much more to come. But let's say we inflate it by another 1%. Upcoming for $2 million, we are looking at almost 6K, and out of the 6K, I have only 3,000 plus in terms of interest, because these are expenses and this is actually your savings. But if I compare to this is about 6,000 plus. This is way twice over. And then the other one is, let's say if we compare 1.5, which is probably the current the rates now, that was only about, this one is about 6,000, this one is about 5,000, and then we got the interest rates of only 1,800. And how long are we expecting this heightened interest rate is going to last? I think I don't expect it to last more than 2-3 years. So I'm definitely not concerned about that. But this will probably be a concern if it lasts 10 years. If it lasts 10 years for like maybe 3 plus 4%, I think there is something, the economy is likely not going to be recovering anytime soon. But we all know that this is going to be very unlikely. Okay, so I think one thing when it comes to investment is you got a foresight to look ahead. And if you don't know how to look ahead, then I think you will definitely make a very bad investor, or rather you won't actually even make a move in the first place. And so in that case, property investment is likely not going to be the form or investment vehicle that is suitable for you, and you might have to go and look elsewhere. Okay, but if you are willing to take all these so-called causes and or rather calculated risk, you know how to calculate your risk, then I think definitely you can look at how real estate can help in your investment portfolio. So we zoom in again back to the 2005 period, which is, I think, honestly a super scary period. And then we see this guy over here. We've got this guy who made money during this period was crazy, going all the way up to almost about super fast acceleration from 2+% to 3+% to 4+% after including the bank spread. And then during this period of time was 2005, 2006. And then the other period was when it was high, but came crashing down. I think it was easy because if you more or less know that the economy is crashing, the government is trying to save the economy, then they will lower the interest rate. I think this is normal. So let's not dwell onto that. We are not here for economics lesson. Then you've got the interest rate rising during this period of time. And these are the profit margins. People actually made quite a lot of profits for those people who got in during this period when interest rates were climbing. And if you are looking to get into property when interest rates starts dropping, probably still lucrative, but definitely not as lucrative, provided you know how to spot your opportunity. So this is a good development. Why? Because out of the history of it, there are only two people who lost money, and there were easily a few hundreds of them who made money. And during this period of time when the interest rates started dropping, people still made money. There were still people who made money, but how long did they hold on for that? You can see the number of days they held for very long. And this is a fundamentally sound property. Let's take a look at the other one. But before that, I show you the chart of this property. You can see prices were climbing, they are crashing, which is normal. Because back then it was still a highly speculative market. And then if you take a look at how a fundamentally sound property should behave, back in the 2013, then after that came down a little bit, not too much of a panic because I don't think this warrants a margin call. And then you went up again in a much controlled manner, and then on the way up. On the other hand, you have one what I call not a very fundamentally sound property. And during the same period of time, went up, came down, went up again, after that came down and never recovered. Okay, both are rather close, both are rather nearby each other. And then you've got your this one, same two period of time, 2005 and 2005 to 2006 and 2007 to 2008. So the increasing interest rate period and the decreasing interest rate period. If you're talking about the decreasing interest rate period, actually most people lost money in this development over this time. And then most people actually ended up making money during the time where interest rate was increasing. Okay. So that may be something for you to think about. On the other hand, the one that seems to be more profitable during it was the period of time when the interest rates were increasing because ultimately the government is trying to claim on the inflation and everything. And only when the recession period or the not so good periods start coming in and people realize, then the government realize, okay, it's time to cut the interest rate. And that is probably back then it could have been a bad time to buy. But then again, we know that this is a very different market that we are seeing right now. I'm just using it as a comparison. I'm not using this as a how do you say it, as a scope to look into the future, because this back then 2005 to 2008 was a very 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 different market compared to now. Okay, so if you put these two, if you take a look at the same period again and you put these two together, you've got a fundamentally sound property going all the way up. Then you've got a not so sound property initially exceeding the price of the good one. And then eventually you can see the price gap starting to widen. So ultimately, how are you able to spot the property that can help you avoid all the buy sell, avoid all the headaches, and then hold on to something that is good versus something that is not so good in the long run for you? Okay, and then if you are worried about the interest rate back then, maybe this guy, if you take a look at the amount of profit, is he actually concerned about interest rate? I think definitely not. Okay, So now back to the future. What are we actually going to be expecting from 2022 onwards? Nobody knows for the future. But what we can do, as what I mentioned and showed to you so far, is that what we can do in any interest rate environment, be it increasing or be it decreasing, is that there are still opportunities. And then if you know how to spot the profit making developments, then you are in for a treat. But of course, if you do not know, you just follow blindly where the market goes. A lot of those that didn't make money or they make much lesser money tend to be those that people like to flock to. And then if you realize that quite a lot of those that make money, they are typical path are like this. Then they started going this. Why is it stuck like this? It's because not a lot of hype around it. Some of the most successful launches in the recent past few years have been those that didn't receive very, very good reception on their launch weekends. But those that actually underperformed ended up most of them, or rather not say most, yeah, pretty much lah. Quite a lot of them actually had superb performance on the launch weekend. So when people, just because people flock in, does it mean that it's always a good buy, or should you go into the empty show flag where you can think logically and take your time to go and think about whether is it a right move for you, or should you want to make and I can safely tell you, having a stress element is most likely going to affect your level of judgment. Okay, so when it comes to the residential price index, we do not want this kind of thing to happen again. Okay, this kind of thing to happen again. So we can see over here, went up, the government jabbed us with cooling measure. After that, went up, jabbed us with cooling measure, and then went up. Slightly more to come. But are we too afraid of cooling measure? In case you're wondering why we have this spike, we all know that during this period we have the, if we go down, we've got the end of 2021, because this one is a Q2. So we've got the Kenny Hills, and then we've got the PG Leaf, all these substantially pulling up the market. So at the end of the day, how does the chart, after all, PPI is a general chart. How does this work? Is that how does it spike up? Because you got absolutely crazy numbers, crazy launches that were not fundamentally sound, but are driven by FOMO, driven by hype. And then you've got your other transactions around here, your typical transactions around here. So what happens is it goes around here. But do you have to be the one that is buying here? So if you use PPI as a chart to base your research, then I think you are not actually researching with a very objective point of view. Ultimately, you need to know what are you looking for. You can look at the macros, the super macros, but ultimately you should look at the macros of the region, and then the specific characteristic of the development. And as long as I feel as long as your characteristic of the developments are fundamentally sound, then no matter what, whether government choosing a cooling measure or here and there, then there's nothing much for you to be afraid about, because as long as you're not buying the one above, you are buying the one that is here, then even if they do jab us with more cooling measures, then it's likely going to be going like this. And then you are safe below. Okay, because you are the one of those that made the chart stay grounded. So make sure you do your due diligence, or if you do not know how, then please seek professional help. So at the end of the day, do you know, are you going to be the one that sits on the fence and looking around while the whole world go pass by, and then look back 10 years from now and be like where we are? Oh, last time I should have bought in 2005, 2006, and blah blah blah. And even those that bought during 2007, 2008, where everything came crashing down, they were still making, some of them, quite a lot of them, still making over 1 million profit. So you just have to make sure that you spend lah. I think you have to really spend a lot of time lah. That's the problem, because people want to invest their money easily, but do not want to put in the hard work to go and find out what are the good deals. And then they only, or when people, there's too much market noise really. You've got people tell them this is a good buy, that one's a good buy, and when the real good buy comes in, they do not know how to differentiate good buy. So please make sure you do a due diligence. Ultimately, data is king. And then when you've got the right course of action, eventually, and then you've got your right safety net for you to walk past. I think in terms of reserve funds, I think there is nothing much for you to worry about in terms of interest rates. How much, even if interest rates go up by 1 to 2K a month, that's not going to be killing your entire investment, because I really don't foresee the rates being up for more than 2 years. If that's the case, then I think as long as you're buying a fundamentally sound property, those who bought into the fundamentally unsound property, they'll be the first to fall. And a lot of them will be falling without safety net. And as long as you are in those fundamentally sound ones, then you'll have your safety net. Very likely you're not going to have anything that's going to be happening to you, at least in the midterm. So those people who are looking at, oh, I just want 3 year return, 3 year term. I think in this kind of market, if you are just fixing on 3 year, unfortunately, I think you just gotta be realistic lah. Okay, if you want to keep having your cake and eat it too, even in this environment, then you've got to be super 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 objective, which I think is very, at least from what I see, is very 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 rare in the characteristics of most of the buyers nowadays. Okay, so yep. So at the end of the day, just make sure that you seek the right professional help. And if you do not know how to look at the market, or how to look at which developments, which specific units, please you can pick the right unit. You can pick the fundamentally sound development. But if you enter at the wrong price, like example, this guy over here, you remember, you see the hundreds of them make money, but only two fools actually ended up losing money. And what kind of price did they enter? Which timing did they exit? So even if you get in the fundamentally sound property, you have to make sure that you enter at the right price and exit at the right timing and price. And how do you know? You've got to have a trusted advisor for you to help in the long term. And of course, if you do need somebody to help you, and then I can be the one in the role for you. Okay, that'll be all we have for today, and then see you guys again. Bye bye.